We're going to use that as a jumping off point for our conversation with Michael Purves of BGC. Michael, given what Scarlett just outlined, can you make a bull case for anything right now?
You can definitely make a bull case for equities right now, although I would caveat that that's a short-term bull case. You know, I see the markets for the year trading really in a range. But as she just pointed out, the dividend yield is not an unimportant factor. The dividend yield on the S&P 500 is higher than 10-year treasuries right now. And it's a very important point that in some ways it's safer on a real adjusted basis. It's a very important point. If you look at cash flow yields on the S&P 500 relative to fixed income, it's very, very important. And I think one thing that the Fed has engineered is that unlike a lot of sort of low-growth, stagflationary environments with volatility we've seen in the past, you often get multiple contraction. And I don't think what Bernanke is effectively achieving here is he's warding off multiple contraction. So I think it's a very good time to be buying, but I think you also have to be very tactical.
Michael, a bit of a wild card. If we do see QE3, right, how does that change your outlook for stocks?
Well, I would say it's. I've expected some sort of artificial stimulus from the Fed for some time. I think it's inevitable when you're coming out of this 80-year banking crisis, particularly when Bernanke sees himself as the last only stimulus game in town. Having said that, new news or anything confirming something, $500 billion stimulus, that's clearly going to be a catalyst to get the market going again in a sustained way.
Michael, I want to go back to your point about dividends, because we're making quite a lot of the fact that the S&P 500 is yielding more than the 10-year Treasury, and so are many people. But how long can that continue? If the Treasury market is pricing in effectively a recession with a sub 2% yield, we've seen that just last week, then at some point that's going to hit corporates and they're going to have to bring the dividend yield down. And if it's not true, then Treasury yields are going to have to climb back up above the S&P 500 dividend yield, right? Absolutely.
And I think that's one of the reasons why I think there's going to be a range-bound market, because eventually flows will come back from fixed income back into equities. And as that happens, that will put a ceiling, because the macro issues that we're dealing with and the impact on growth around the world will keep equities range-bound.
Well, somebody else who's been taking a close look at Treasuries is our own Sara Eisen. She's here. So, Sara, we've talked about this 2% right now, what, a 2.08% yield on the 10-year Treasury. What is the bond market telling us about the economy?
It's sending a very clear message to Ben Bernanke, and that is do something, and do something right now. We talked to strategists over the weekend, and Barclays Capital, you threw out the $500 billion level, Michael, in terms of stimulus for the Fed. Barclays says that if you look at Treasury yields right now, record lows for the 10-year, that is pricing in $500 to $600 billion of more Fed stimulus coming soon. Ben Bernanke speaks at Jackson Hole this week, Friday. That will be the highlight for financial markets of the week. And there's a lot of expectation, whether that'll be warranted or not, whether he'll be able to satisfy the markets, that he will do something. QE3 built in, according to some of the biggest strategists out there.
So has the market effectively put Ben Bernanke in a box, Michael, if we do not hear something from the Fed in the way of QE3, that there is going to be some kind of a big sell-off in Treasuries coming by next Monday?
Well, we'll see. You know, he has an employment mandate and an inflation mandate. He doesn't have an S&P mandate, or at least not overtly, one would think. But I think if anyone's put him in a box, it's arguably Congress and over the last few weeks. But yeah, there's going to be pressure there. He doesn't want to see the S&P decline, clearly.
But what if he doesn't do anything?
If he doesn't do anything, I think it's going to be. Well, you know, I think he will be doing something. Clearly, he'll clearly be rolling maturities, and the question is how much. Is it, you know, 10 billion a month, 15 billion a month, 20 billion a month? That's the big question. You know, back during QE2, we had $60 billion a month on average of stimulus. So there's all sort of stealth or stimulus light that will be going on. And, you know, so long as the liquidity is coming in to be the big bid in the fixed income world, that will be really what's the most important thing, regardless of what it's called.
Talked about stocks. We talked about the possibility of QE3 if it happens, if it doesn't happen, what it means for treasuries. We want to call our attention now to the metals market. Gold has been absolutely on a tear. It might have its best year in something like 30 years. You even are surprised. You're a gold bug, but you've been surprised with just how fast this price has accelerated. Where do we stop this year?
Well, my price target for the year has been 1,800. We got there a bit faster than I expected. I am a structural bull on
the compressed version.
Right. Yes, exactly. It's the compressed version. And if you look at what happened to silver back in April, when the slope of the rally starts becoming too steep, margin requirements come in, and it dampens the price of the metal very, very quickly, or some big sellers come in. I'm a structural bull on gold. I think over the broader term it will be much higher than $1,800 on a sustained basis.
Like 2,000?
Oh, easily. No, I would say if you look at what gold has been doing over the last few years, most years it's been doing sort of 20 to 35% rallies against the U.S. dollar. That type of rally I would expect going forwards. The gold story is about accumulation. It's really not so much about fear of a particular headline going on in Europe or a U.S. downgrade. What it is, it's a long-term, multi-decade story about people diversifying their currencies. That's a process that takes time. That's why every dip will get bought, and why when the rallies get very steep, like we're seeing right now, the traders will come in and sell those and take profits.
So, Michael, if gold is getting a bit ahead of itself, and we're talking about bullion here, yet you're still a structural bull, as you put it, on gold, how would you invest?
Well, what I've been recommending to clients is to swap gold exposure for gold miner exposure and for silver exposure, which I think have much better risk-return profiles. The gold miners in particular have been very weak performers this year, really underperformed the metal. And if you look at the ratio of gold price to for example, the GDX, a very liquid ETF that tracks the major gold miners, it's at the ratio that it was back in March of 2009.
Do you expect, though, that gold is going to experience the same kind of volatility that silver has experienced this year? I mean, you're right. You're calling for silver to get to $45 by the end of the year, and it's almost there. But it was at 48 plus back in April, at the end of April, and it crashed from there. Nobody wants to live through that kind of volatility. We've just seen it in stocks.
Right. Well, gold volatility, implied volatility on the GLD, for example, I'm on an options desk, and we look at that very closely. That's gone up quite a bit. But over the broader term, what's very interesting about gold volatility is that it's actually declining on a longer term basis. So you see these short term spikes when various events in the world happen, but I would expect those spikes to mellow out pretty soon. And similarly for silver, I think that volatility story, that notorious volatility, which is why so many investors have avoided silver, will fade.
All right. Buy gold, buy silver, according to Michael Purves. Thank you very much for coming in, Chief Market Strategist, also head of derivatives research at BGC Financial.